In this video, we're going to talk about budgeting for your new home. Stay tuned. What's up everyone, Andrew here with the Lake team in Houston, Texas. Welcome back to our channel. We have another fantastic video lined up for you guys today. And if you're watching this on YouTube, go ahead and smash that subscribe button down below if you haven't already. We try to produce the best real estate content to put out to you guys each and every single week. And with that being said, we're gonna move straight into today's topic, which is budgeting for your new home. So if you haven't already checked out the video that I made previously on the actual cost of home ownership, I'll place a link in the description below, or I'll put a card up here somewhere. But be sure to check that video out. We go all the way in depth of the actual cost of owning a house, and this will help you budget and prepare yourself better for the new house that you're about to purchase. But just a quick recap on that video, we did an example set at $300,000 purchase price with a 5% down payment, which was $15,000, and the interest rate was about 3.25%, and the tax rate was 2.27%, and the entire cost of the house we included everything in this video, so if you want to go check it out, go check it out. But the entire cost of owning that house monthly broke down to $2,446 a month. But like I said, that's a quick example and a recap of a video we've done. Every situation is different. You might be purchasing a smaller house or a larger house. It just all depends. But that example for that video was $300,000. But moving on, we're going to move straight into budgeting. And the first thing you want to kind of narrow down, which you should already know in the first place, quite obviously, is your monthly take-home pay. Right? What is your monthly take-home pay after taxes? And from there, what I would do is subtract any debts that you have. Right? So if your monthly take-home pay is $6,000 every single month after taxes are paid out, and you have any debts, say $400 or $500 car notes, maybe $300 in credit cards, $200 in student loans, whatever the case is, go ahead and start subtracting all of that from your monthly take-home pay, and then you'll get an overall net figure of what you have left over after your primary bills, basically. The bills that have to be paid are paid at the end of the month. So also I want to touch real quick, whenever it comes to budgeting for your new house, and most people say, well, I'm going to get a raise next year, I'm going to get a raise hopefully the next 6 months. I like to tell people, don't ever count your chickens before they hatch, because you never know what could happen. You could get laid off, you could get transferred, or you may just quit or get fired. I mean, who knows, whatever the case is, don't count your chickens before they hatch. Go off of what you're making now, not what you're going to be making in the future. That way, it's better to play it conservative, have a conservative approach in this regard, rather than hoping and praying for the best, and then it just doesn't turn out that well. So the next thing I would do is subtract any expected changes in the cost of owning your new home. Of course, if you have a house to sell and you're renting right now, don't include those payments. Go ahead and exclude those payments, actually, because you're not going to have those payments in the first place. Once you leave the residence or wherever you're at now, whatever you're paying for, you're not going to have that bill any longer when it comes to the new house. But if you're expecting a $1,400 mortgage, $1,500 mortgage, $2,000 mortgage, whatever it is, go ahead and when you're budgeting for this, subtract that. Whatever you're anticipating for the loan cost to be, and any extras like HOA fees, cable and internet, things like that, and then kind of get a feel of where you might be at the end of the month versus your take-home pay, or when you're subtracting your take-home pay from all those expected expenses of owning the house, the new house that is, and then see if at that point you want to see if you're comfortable with it or not. So my biggest advice for people is don't stretch yourself too thin. I know some people really want to get into a home, or they really want to upgrade a home. That's okay. Just don't stretch yourself too thin. Don't put yourself in a position where your house broke. That's a pretty bad feeling. You have a house, but you can't afford to put any furnishings in there. You can't afford to go anywhere on vacation. You can't really afford to do much except for owning that house. Don't stretch yourself too thin just because you get approved for, let's say, a $400,000 or $500,000 house. That doesn't necessarily mean you need to go out and spend that much. Nobody knows your finances like you do, and what you're comfortable with with taking on as a monthly payment, in addition to everything else that's coming on top of that. So don't stretch yourself too thin. Keep it to where you're comfortable. And piggybacking off of that, I want to stress the importance of saving for an emergency purposes. So we like to take 20 to 30% of our income and put away in a savings account just in case something were to happen. And we have those funds there, and it's in our savings account, and we're not touching it. It's in the savings account, and it's there should we need it. If we don't need it, that's great. At least we're building up an account, right? You have those funds readily available should you ever need them. The next thing I would suggest to you guys is go ahead and start talking with the lender and getting your pre-approval process started. That way you know where you stand in regards to how much money you can borrow to purchase a house. And if you can't qualify, at least at that point, the lender will be able to let you know what you can qualify for, or what you need to do to qualify. Maybe you wanted a $450,000 house, but it turned out you couldn't get approved for that amount, and maybe it went to 300. So maybe you need to change a few things. Maybe you need to pay down a couple of credit cards, pay down some debt, whatever the case is. But at least at that point, the lender will be able to give you some sort of direction on where you need to go. And on top of that, the lender will be able to break down all of the costs associated with the purchase that you're about to make, and they'll be able to give you the taxes, they'll be able to do the tax payments, principal and interest, and the expected insurance cost with everything. So it is best to go ahead and talk with the lender if you are thinking about buying a house, because they'll be able to break all that stuff down for you, and then you'll be able to budget properly for your new home. One of the last and probably most important pieces of the puzzle here when it comes to budgeting for your new home is if you do have a financial advisor, I would suggest go ahead and consulting with them. They'll be able to let you know and voice their opinions on a decision that you're about to make. If they think that you're stretching yourself too thin, if they think that you have more wiggle room to go up in price, whatever the case is, your financial advisor, if you have one, your financial advisor will be able to help you in making an appropriate decision. Well, that's pretty much going to wrap it up for today's video. Let me know what you guys think in the comment section below. And if you have any suggestions or topics you'd like me to cover, go ahead and make that in the comments as well. If you have any questions, you could reach us at our website. I'll leave the link in the description as well. Also, don't forget to hit that subscribe button down below. That way you'll be the first to get notified whenever we release new videos, which we do each and every single week. And at the Lake Team, we try to produce the best real estate content to put out to you guys and educate our consumers and our potential clients the best we possibly can. I'm Andrew with the Lake Team, and I will see you guys next week.